Volatility is down to multi-year lows. At the same time, stocks are making record closes. So will the Federal Reserve be able to intervene and actually stop this market from going up anymore? And do they even want that? Sticky November CPI showed that higher rents and used car prices were the concern. But markets didn't care anyway. A dulling market continues to drive higher. And today we discuss why options could be the main cause of what's going on right now. We also need to be talking about everything to do with yields coming into the biggest monthly news event that we've seen so far. Expect volatility to potentially spike. And why is that? Because it hit a level that we've been looking at for quite a long time now. Join us as we cover stocks, commodities, and cryptos together. Well, welcome back everybody to The Daily Show. My name's Tom. We've been running this show for over 3 years together. And if you like anything to do with markets, please remember to subscribe. Let's get into everything going on though in the markets. First up, Oracle was the underperformer of the big caps and energy sector was not doing well. This was an interesting one because the setup coming into the CPI could have been amazing, but unfortunately we didn't get the trigger. More of that later on as we discuss energy in great detail. It's a very interesting area at this stage. We also know that options is the hugest deal this week other than the FOMC and the interest rate decision. But what happens in quadruple witching when trillions of dollars are at stake? The stats might surprise you. And you can see here the performance surrounding the quad options expiration can get a little shaky from here on out. The Wednesday, the Thursday, and of course the day of tends to be an interesting point. And then also the one trading day after. This is where we tend to see that volatility spike. So be on the lookout over the next 24 to 48 hours. Let's also discuss everything to do with options right now. We just hit a 2-year high with $3.6 trillion of options being put into the markets. It's pretty extreme. And of course, we've also got a huge differential here between the calls and the puts. You can see calls absolutely exploding in recent weeks. So why are retail traders getting owned here? Well, a lot of it has to do with why the markets aren't even being able to be sold. It's because too many people are bearish in terms of their positions. We've all seen the sentiment reports. The sentiment reports show that everyone's bullish. But the reality is in leveraged products, there's a lot of people still going negative on markets. SPY is 66% bearish. That's actually a new high in terms of the bear positions placed there. And the Dow has been between 80 and 90% now for a few weeks. Same with the DAX. And of course, we've also seen oil on the bullish side, 90%. We really need these things to change. And oil, we'll talk about later on, it might have actually started to put in some pretty serious structure because this is one of the big deals. Another deal, though, has to do with options. And it turns out that there's about approximately 7 puts for every 4 call buys at the moment. Usually you do have more puts in general. And it seems like this little squiggly line is kind of the expectation at the moment of the market moving forward. So effectively, we're moving kind of through that area into the 4700s in terms of where the market pin is. Now, this may change over the next 24 hours, but we'll see if we can update it as we see more options come in. It seems to be quite accurate when we've gone through the last couple of weeks and we've been dully moving up. It seems to be pinned to certain levels. If you're interested in more of this type of stuff, remember to subscribe to our free weekly newsletter. Links in the description down below. Let's get into some stats and let's go over everything that looks the best in the markets right now. First up, New York Stock Exchange, 52-week high, low spread. Now, we have a lot of data from this point, and of course, it gave one of those signals, those buy signals, just the other day, and it tends to be relatively accurate. You can see there's one bad sell signal, which was saved by the Federal Reserve, and it's just given another buy signal. So how many data stats do we have for this? Well, it turns out a lot. You can see all these red lines, all these red dots here, and it usually marks that we're going into a bullish period, but there can still be pullbacks after such an event. So let's talk about what's going on in the markets. And firstly, I want to mention oil because it got absolutely collapsed over that inflation number. Now, if you've been looking at the XLE sector, you'll notice that there was a potential for a bit of a rally high. This is something I was talking about in our private community that we have, links in the description. And basically, I was looking for a gap up. Now, of course, CPI, it was all down to that. But as you know, we talk about patience, react, don't predict. So in this case, we didn't get a trigger and it didn't happen. Sometimes that is how it occurs. But let's go back over to oil for a second. We're in a very interesting zone. So we know between 67.50 and 69.50 is where we expect all the shenanigans to go on. We actually got a small time frame change of trend over here that was looking kind of promising towards getting into this area here, which it almost tapped into 72, very close to the supply. And then, of course, we could have gone even higher. That's still possible, but for now, it's too early to call on oil. We'll have to see more. More trapping needs to be done because clearly retail still has 90% buys outstanding. It's going to be a little bit difficult for that to spike up. So let's talk about the elephants in the room. The first one with oil is, of course, everybody's concern over the amount of barrels outstanding and how many are inventory. We have been seeing that, and of course, that's the October read. But let's talk stats. What's going on since we see reads like this? This is when we cycle from a 52-week high to a negative 25% drawdown. We just got a read here, and you'll notice that we've had quite a few of these. Some of them have been absolutely horrific and they've fallen off, but there's been a lot where we actually see structural basing for a little period of time. Something that's interesting when you look at the visual chart here in comparison to the data. And 1 month later is the point that we're really looking at. So we'll be looking at oil, we're paying a little bit of attention to it. I think it's an interesting point. Another factor is the next 6 months. What goes on when we see bad oil reads? You might think, well, this means the economy is going down. As long as it doesn't absolutely collapse, oftentimes we do see actual rotation into small caps, which we'll get into later on. The US dollar also has 1 and 2 week poor performance around this period of time, and that might be telling when we see the FOMC meeting. And of course, it could also lead into some okay strength in the markets. Let's talk small caps versus large caps then. This is the time that usually small caps come into their own. Now, on average, between December 11th and February 11th, we see an 8.1% return. Large caps usually only do 3.3, and you can see there's a big difference. The actual swap between each one is pretty popular and certainly a move that we tend to see happening in the markets. So will it happen again this year? Well, you can see that we didn't get that pullback so far anyway. That is usually occurs into the middle of the month. The 15th is usually where we get a pullback of some instance, maybe 1 or 2%. We really only saw a kind of sideways action from that area. A lot of people are bringing up options as well as a reason not to be in small caps because of those call IWMs. Well, we've seen similar reads like this. And of course, does it usually have negative factors? Not really. I mean, in pretty much all the circumstances here, we've tended to see quite strong gains in IWM from these points on. It's more to do with the rotation. But I wanted to get into this idea of IWM, the Russell 2000. Is it really the best market sector? Not really. Remember, the thing about the Russell is that there's many companies in there that actually are very bad and they're not very good. And you can see that when you look at returns, it really is a factor. The top 10% of the S&P 1500 have done quite well. Big is better when it comes to America, and that's usually the big way to go. It's the same with quality. You want to be looking at quality inside of the small caps and the mid caps, and one way you can do that is by looking at stocks with relatively speaking decent moats. A lot of them have already been moving strongly, but even RSP is an interesting one, which is the equal weighted market, which could be another way to look at the markets themselves. Let's have a look at S&P 500 earnings, revenue, and revisions. Of course, we are still seeing expectations of 2024 being really good. I mean, here's the average. Earnings is expected to be 11.8, and then we have sales at 5.5. If we were to go above 10-year averages, 10-year averages are standardly 5% for sales, and for the overall earnings, we're usually looking at around 8.4%. So you can clearly see that the market's getting pretty hyped on 2024 and how great it's going to be. I'm not sure it's going to be super awesome because realistically, just recently, we've seen expected revenue growth starting to fall. In almost every category outside of energy and utilities, we've seen downgrades since September. Now, this is becoming a factor because, of course, the markets are rallying out of control, but something underneath is starting to rotate around. It's worth paying attention to this storyline moving forward, although it's not going to have an immediate impact on, of course, our market rotations. What about revolving consumer credit? I've seen a lot of people talking about credit cards and how bad they are. Well, I think it's important to bring credit cards back down to earth. They look horrible when you look at some ports of data, but of course that can be manipulated. Real revolving consumer credit here by the Daily Shot shows that deflated by CPI numbers, 2016 dollars, we're not really in super problems. So of course, I wouldn't say that credit cards are a biggest issue at this stage. What about the FedWatch tool coming into everything to do with the interest rate decisions? It's expected that there'll be no rate decision change, And this will mark, of course, the 5th month, which again, I've shown you before, has 100% track record so far, which of course is just history, of not ever seeing another rate hike. So of course the market may like that if they don't get one, but I'm sure Jerome Powell will come out and try to slow the market down. You know how his speeches are. He just says the same thing. The market then claims it as a catalyst and we get all sorts of volatility coming through. In 2024, this is a chart worthy of being saved. This is the outcomes in terms of the bullish outcome and the bearish outcome in history of what goes on when the Fed actually starts cutting, and we'll be looking for real growth. So, of course, that's why we'll need to come back. This one's for the bears out there. Of course, if you look at this chart, you'd be like, yeah, why would I buy this market again? So S&P 500 valuations shading indicates that metric is statistically expensive relative to history. So almost all the metrics are as of November 2023. Now, yeah, I don't think this comes as any surprise. A lot of these metrics would be out of date. They wouldn't necessarily work anymore, but take a look at some of these percentages and it shows you that, sometimes you want to be cautious, but there's some crazy ratios for you to pause if you want to have a look at it anyway. Let's move over to consumer staples, materials, and healthcare. These are all laggards compared to the Mag 7. What we've had in recent days and really recent weeks since we've started talking about it is a rotation into mid caps and into laggards. So laggards are doing better than the Mag 7, and we can really show that by looking at the Mag 7 on a chart later on. Another one is going to be the Grinch. Don't forget the Grinch. We'll bring this up quite a few times. 3 days coming into Christmas plus 3 days after. Depending on the results here, it could shape a lot of the statistics that we start breaking down for 2024. So I'm going to be looking for the Grinch for sure. Now, we know that options expiration week does tend to be positive. Yeah, this week it has been so far. But we know those 3 days in particular are the ones where the volatility and the negativity comes in. So it's not unusual to see the Monday and the Tuesday strong. It's the Wednesday, Thursday, or specifically the Thursday that most people are looking at. And of course, this week is also the Fed week. Mag 7 showing that net exposures are going down, which gives you a bit of a reason why the Mag 7's been a little bit underperforming at this stage over the last week or two, which has been almost a month now. And of course, this is another one that I'm just going to keep putting in the charts here just to show you when you see downgrades or upgrades, it's not necessarily the best read. So Moody's downgraded China. From that point, we've generally seen the next year be positive. I'm just going to read the numbers again here. Plus 9.8, plus 41.8, plus 89.3, plus 19.8 in the other 4 times this has happened. So don't always believe these investment houses when they come out with the reports. It doesn't always work out for you if you do. What about Goldman Sachs CTA estimates? Well, of course, they have all been on the downside, but we just saw today the huge options market, which is really pinning everything. And that's a huge point of why we're rallying up at this stage. There's a huge amount of hedging going on. And of course, there's trillions of dollars at stake. So whatever makes Wall Street the most amount of money seems to be the best play at this stage. Max Payne doesn't seem like it's coming in this week. It looks like there's actually, because of zero DTEs, there's a whole different ball game in terms of where the actual pin is for the most profit from Wall Street. And so a lot of it has got to do with most of these positions actually being sold. So there's a lot of sold options out there. Now, we had some big reads in terms of dark pool. It was pretty slow 24 hours. Expect this to be big over the next 24 hours though. So come back and watch tomorrow's video. We did see a big one coming into KWEB, which is of course China Internet ETF. We also saw an interesting one come through the S&P. Now, I want to talk this level because this is actually the level where I would have expected a short to come in. And it's because of the reaction to our watch reaction here zone. So this is actually where I'd usually expect a short to occur. And it's just interesting there was this big piece of data that came through. Now, remember, when they put volume in, it doesn't necessarily mean it has to sell straight away. They don't have stop losses like you or I would when we're trading, or they don't have really, short-term timeframes. They're position-based trading. So that's a very interesting read there in terms of unusual activity. Here's where we stand in terms of the net for the week in terms of as of the close. The net technically is negative delta exposure, but as we saw before, at this stage, it looks like we're kind of on that pin through those strikes that we saw before. In terms of options, extreme movements, whether we had any individual stocks that were doing anything wild, it was low, 32.8, 57% calls. And you can see here that retail made up 28%, which is pretty normal. I don't think there was too much to note here in terms of the options world. It was the calm before potentially the storm, which is, of course, going to be the Federal Reserve. Now, here's where things get a little interesting. We actually saw effective yields go up. So you can see here a bit of a spike. It's fallen off the chart, but it's gone up. So the S&P is going up, but effective yields are going up. Watch this space. We'll be coming back to that one. Equal weight market did pretty well. It's a nice new day for it, going up. Still not at new highs like the S&P just broke through. So it's got some catching up to do if the bull run continues. In terms of our bond indicator, hey, it just looks really strong. So that's been pretty good. And US 2-year versus 10-year shows us that we don't need to be concerned about the market freaking out into a recession kind of situation at this stage. What about the American consumer? That continued to hover around this high, waiting for news, no doubt, but not looking bad. The US 10-year dropped, and it actually gave two opportunities. I'm not huge on trading 10-year. Obviously, at the moment, I'm thinking TLT could be at the sell point, but it's a hard trade, always is a hard trade, bonds. But you can see here that we didn't quite get through our 4.3 read. This was definitely what I was looking at the start of this week. I put it in the newsletter, and I'm actually pretty keen to see what it does because this spiked up, which usually shows that there's someone trying to buy here. And there's both a sell side and a buy side in terms of straddling this. So there are both two zones of breakout here and two very, very real possibilities. And you might say, well, there always are, but these are both statistical possibilities. So it's interesting. And I think the FOMC will give it to us. Patience, react, don't predict, usually the best course of action here. Treasuries have got that island reversal in them. This will no doubt be a mover over the next 24 hours. We'll start to see what the Fed is saying, whether the markets, want to actually start dumping off and putting yields back up. We'll find out. I still expect Jerome to say all the normal things. We're going to keep it higher for longer, try to convince the markets of that. Whether they feel like trading that way, we'll find soon. PCC, nothing much going on. We see here home builders continuing to hold themselves. And of course, the S&P 500 and liquidity watch is that central banks have remained stable, but certainly haven't cut their liquidity. So no concerns there from the market and the bull run currently. Copper has kind of like a potential buy signal on it right here. There is also a sell signal right around this zone here, which we were talking about coming into this week. So it's another one where you've got both a buy opportunity and a sell opportunity. Members of our day trading masterclass would know what I mean, but they are so... Yeah, there are actually a couple of sets there that are interesting. Dollar, it's clearly positioning for a big move. It's trying to figure out whether it wants to break through 104.5 or go down. Statistics based on what happened with, of course, oil would tell you that maybe the dollar is settling for a down streak. But yeah, again, patience, react, don't predict in this case. Gold, well, we already know this is slow after that huge blow off. That was absolutely the end of the run for now, and we're looking for structure to be formed. Now, we've already talked a little bit about US oil, but just remember this is an important level. There's a lot to focus on. There's levels to be set now. We'll set some alerts from highs. I'm going to set alerts from lows. I'm going to set little alerts from up here as well. And I'm going to be watching oil quite a lot over the next couple of weeks. I think it's just an interesting point here for it. What about Tesla? Still trapped. Maybe it can get out through FMC. So we saw another price down to 234, and we continue to hold this level. Remember, if we get through 230 or we get to 254, we expect a relatively big move. It's a coiled market getting ready to hopefully move in a big way. Semiconductors continued their strength up. This was probably one of the best market sectors of the last 24 hours, and it doesn't really look weak, does it? It just looks kind of strong. So that is what it is. Getting into it now, though, is probably not the greatest idea unless you've got a good trend following system. And the German DAX. Now, this one has been squeezing everybody. It's been one of the heaviest shorts from retail trades. And you can see we actually started to go sideways. So I mentioned on X that because we just saw a negative 8%, so that means 8% of people went bullish literally here, and we saw 8% of shorts get removed effectively from that reasoning, then you can see why we're going into a sideways action. I'm going to expect chop even downside here from the DAX, and it's just purely because we saw that first change. Now, it's interesting to see the doji, so obviously we'll be looking for chop here, but nothing yet that we can really read into it from any statistical standpoint. Still dull, still making a series of higher highs and higher lows. US 2K ended up putting in a doji. It actually got my alert there, And I was looking for it to move towards 1920 after this, but then it didn't even hold up above that zone. So again, FOMC is going to ride it. 1920 though would be an interesting level for the bulls. And then we've got the NASDAQ and the Qs. So the Qs did a really strong move here. They were probably one of the better performers, 0.8%, thanks to semiconductors. And they moved into our green box. Now, anybody can see this box, okay? Everybody knows that this is the highs, and this is really where we're going to see everything, because, of course, that's the all-time high for the Qs. So it really depends how the market wants to trade this. If it wants to go the standard, Christmas kind of rally, keep pushing up, then hit a new high, then sell off maybe next year. That's certainly a possibility. I would keep yourself flexible to all possibilities here. We saw reaction off my watch reaction zones. You can see the reactions here, but they were really weak reactions. They sold off, then they rallied up, and we saw a couple of large transactions with the S&P, and then, nothing much happened. So let's talk S&P 500 now. And I think it's clear that this is obviously just continuing to rally. One of the things that becomes pretty apparent when you look at S&P is that it's had 6 weeks, almost 7 weeks now of bullishness. Now, we've already talked about that being an unusual time. Unfortunately for bears, it's not going to be a necessary sell-off. It can actually chop, move up higher, and then sell in 2024. But the one thing is, if it does do that chop into higher, I wouldn't feel that 2024 is not going to be without its super volatility. So that's because this is not exactly healthy when it goes up so many weeks in a row, even though we're starting to see some rotation. Let's talk Bitcoin here for a second, because I want to bring Bitcoin back to the markets. This was the dull market that we were seeing the other day, and we were talking about how Bitcoin had been quite strong. In fact, we'll put Bitcoin here because we've got a 20 moving average. And we'll go to the daily here for a second. So you'll notice that Bitcoin's sitting on this 20 moving average. It's found a lot of dynamic support here. But more importantly, it had these two kind of monster runs where everyone went absolutely psycho on how good is Bitcoin, it's great, it's coming back. And then all of a sudden it does one of its famous flashes. Now, Bitcoin has had a small change of trend. There is a good chance that around 43,500, there could be some bears sitting. And it's even possible, unfortunately, for a lot of bears that might want to get cheaper prices, or people that want to get cheaper prices, that this is a distinct possibility into the halving event. It's kind of classic for it to do something like that. That's the typical Bitcoin. Sells off, finds another rally, and then dumps a bit after that into the cycle. Let's talk US 500 though, because this is where I think it gets interesting. First up, I want to talk about the reaction. So I wouldn't have blamed people for having a go at this. This was a level that we talked about in our last video. And really, as we go through down the timeframes, you actually did get a reaction to it. We can see here we got a sell. The scalpers and stuff, they might have been pretty happy with that, pulling out a couple of points. I mean, it went down, 10, 15 points fairly quickly. Unfortunately, for a lot of people, though, this would have been the zone. Now, this just so happens to be where we found that unusual volume activity. So the unusual volume activity was right in here. And then, of course, markets drove higher after that. Now, it's the nature of a dull market. It's very hard to sell in small timeframes. But again, this is just a zone that I think would have been statistically probable to have a go at it. Although, most people always just go on about like wins and stuff. But yeah, I think that would have been fair. Now, I was sleeping personally, so I didn't get a chance at it. But I was thinking about this morning, and I was thinking, yeah, it probably would have been a go. Now, instrument selection would have been really key. A few people have messaged and said, I tried in here and, I got stopped out here. Well, you could have also had a look at options. Now, of course, why would you do something like that? The only reason I want to bring it up is because we know that we have OPEX. We know that we have some volatility that comes into the end of the week. And of course, we have the FOMC and our good friend, Jerome Powell, which we already expected he would probably bring the most amount of volatility. Well, as it turns out, if you've done an option, yes, okay, it's down against you from where you did it, but it's given you the ability to potentially see what happens next. What about Jerome Powell? What about, of course, the OPEX? It's just something I wanted to bring up. I hope you enjoyed it. If you do enjoy that type of discussion, then let me know. Where to next, though, for the US 500? Well, at this stage, we know that this week's pinned pretty heavily at 4,700 from a resistance standpoint. I don't think it should be able to get through that point this week, at least in the close. So that's the upside. We've talked 45 and 44s as also pins. Of course, 44 seems absolutely improbable. At this point, Jerome would have to crack the market pretty hard to do something like that. But I do think that we're at this stage in an upward trend. There's not much we can do about it. We have to be patient, react don't predict. Predicting the short here is just too hard. I mean, if anything's been proven for you so far through this squeeze, is the US 500 hasn't given sell signals other than very small, very questionable day trader kind of signals, whereas the markets like the DAX have just basically just been bullish the whole time, squeezing everybody out. Until that changes, you're not really going to get a significant pullback anyway. So we'll need to be watching for it. And of course, we will be on this channel, so make sure to subscribe. So what news ahead? Well, of course, here we have the big one, which is going to be the biggest bit of news, which is the interest rate decision. That comes out on Wednesday, which is the FOMC interest rate decision. But really, it's Jerome Powell at 2:30 that I think matters. We don't expect the FOMC interest rate decision to do anything in particular. And of course, then we've got quad witching and trillions of dollars of options expiration. So we'll be talking more about that as we see the options move through. Expect some volatility coming in over the next 48 hours, guys. We saw what happens in previous December OPEX years. If you enjoyed what you watched, subscribe, smash that like button. We'll see you in the free VIP weekly newsletter. Bye for now.